The delicate trade truce between the United States and China has fractured, signaled by U.S. President Donald Trump's declaration of an additional 100% tariff on all Chinese imports, effective November 1st, 2025. This new duty is to be levied over and above any existing tariffs, potentially raising the total tax on Chinese goods to over 130% in some categories. Crucially, the U.S. will also impose export controls on any and all critical software, starting the same day. This aggressive American move is a direct and retaliatory response to Beijing's prior action, the expansion of its export controls on rare earth minerals and their refining technologies. China's rare earth metals are indispensable components for high-tech sectors globally, including electric vehicles, advanced electronics, and defense systems. By weaponizing its near monopoly on these materials, Beijing sought to gain significant leverage, which Washington deemed an extraordinarily aggressive and hostile order, forcing an immediate financial countermeasure. The primary reason for the renewed conflict is the strategic battle for technological supremacy and supply chain security. China's move to restrict rare earth exports was intended to safeguard its national security and interests, likely in response to earlier U.S. curbs on semiconductor exports and the blacklisting of Chinese tech firms. However, weaponizing these minerals, which China dominates by controlling over 90% of global processing, hit a nerve in Washington. The U.S. tariffs are thus a mechanism of financial counter-leverage, attempting to punish China's overall export economy while simultaneously securing domestic access to critical materials. The immediate consequences were seismic. Global financial markets reacted with sharp sell-offs, with major U.S. stock indexes tumbling over 2% amid widespread fear of economic fallout and demand destruction. Oil prices also depreciated significantly, reflecting trader estimates of a broad decline in global demand should the tariffs be fully implemented. Furthermore, the escalation has jeopardized the anticipated meeting between President Trump and President Xi Jinping at the Asia-Pacific Economic Cooperation Summit, signaling a collapse of high-level diplomatic channels just weeks before the deadlines. The long-term consequences will involve severe supply chain disruptions and measurable inflationary pressure in the United States. Tariffs are taxes paid by the importing country's businesses, which are typically passed on to consumers. Analysts estimate that the 100% additional tariff could add 0.2 to 0.4 percentage points to U.S. headline inflation over the short term. Key sectors facing the most immediate pain include technology and electronics. Nearly half of U.S. imports from China are electronics, components, and devices. Renewable energy and electric vehicles. This sector relies heavily on Chinese processed lithium iron phosphate, graphite, and rare earth magnets for batteries and wind turbines. Defense, the industrial base, which depends on specific rare earth elements for sensitive components, is directly exposed to China's export controls. Software, the new U.S. export controls on critical software could severely impact China's AI and cloud computing industries, creating a parallel front in the tech war. This escalation sets the stage for a period of extreme economic volatility and political brinkmanship. One likely prediction is that the November 1st deadline will be used as maximum negotiating leverage. The U.S. administration may temporarily walk back the tariffs if Beijing de-escalates its rare earth controls, but the underlying structural conflict, the decoupling of strategic supply chains, will remain. This latest move marks a clear shift from targeted protectionism toward broad economic containment. China, which appears more deliberate and better prepared than in previous trade spats, is likely to respond with further non-tariff measures, such as imposing new port fees or opening antitrust investigations into U.S. firms operating within China, thereby punishing sectors where the U.S. still holds a competitive edge. To mitigate the current risks, key solutions must focus on supply chain resilience. The U.S. government and its allies must accelerate efforts to diversify critical mineral and manufacturing supply chains away from China, pursuing friend-shoring or near-shoring to reliable partners like Canada, Australia, Vietnam, and Mexico. Domestically, massive investment in rare earth mining, processing, and refining technology is crucial to break China's monopoly position. For businesses, the immediate solution involves proactive inventory management, finding alternative suppliers in Southeast Asia, and hedging against currency and regulatory volatility to absorb the inevitable rise in input costs before the 100% tariff takes effect. Ultimately, while tariffs may serve a geopolitical purpose, sustainable global economic stability requires open, rules-based, and non-weaponized trade flows.